Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He's speaking to us from South Florida. Welcome back to the show.
Exactly. Thanks much, Jim. I always appreciate your inviting me on.
Well, Labor Day happens, the stock market opens, and what happens, Rick? Somebody opened the gate and the cows are running for the hills? What?
Could there be a more obvious day to reverse course with this bull market? You know, it's almost like they actually do meet in a smoke-filled room and said and decided, hey, Labor Day's coming up. Let's change directions. Really stupid.
Well, can you describe what happened and what you think's going to happen and how this setup was totally predictable?
If not totally, certainly no surprise. You know, we've been talking, you and I, about a few scenarios for the last few months, and my favorite, not necessarily a huge favorite from the odds standpoint, but it was that we'd have a 1929 type top where any high that was made in June or July would be followed by, we did have a hellacious move down at the beginning of August. You know, everything came down really hard. And my number one scenario was that whatever rally we got from that low stopped just shy of the all-time high. And that was it. And scenario number two was, and I put out a chart of IBM, the way it collapsed in 2008 to illustrate, and that was where we did have a June-July high in the broad averages, and we came down really hard, which we did in the first week of August, and then the rally actually made a marginal new high. And I experienced this as a forecaster myself in 2008. You know, IBM made that first high, and it occurred very close to a hidden pivot target of mine, and then it came down pretty hard for a few weeks. And just as I was patting myself on the back, it turned around, and of course you think, oh, this is just some dead cat rally, and you kind of ignore it, and you ignore the fact that you've got a short position on. And before you know it, it makes a dash for the old high, and you're trading above it, and you're losing money, and at that point everybody's bullish. All of the shorts are forced into being bullish because they've got a cover on the breakout, and of course the longs are dancing in the streets because the market is obviously on its way to the wild blue yonder. But what happened was that 2 months after IBM made that top that just about hit my target, it made a marginal new high that exactly hit the target, and I didn't have the presence of mind to say, well, this is just a fool where it's going to come down, and it did. It came down so steeply, it came down so viciously that virtually you could see everybody was on board. Everybody was in. Everybody was bullish. There were no buyers to support higher prices. So the market really came unglued, and IBM, the crash of 2008 is something to behold. So we may be right there, because we did have a high. It was in mid-July, as far as the industrial average, the high itself occurred, I think around 40, little more than 41,000 and 41,300 something. And it came down all the way to 38.5. So it was a 3,000 point sell-off, which seems like the beginning of the end, especially if you're a perma bear. But lo and behold, from that low somewhere around the beginning of the second week in August, we rallied to a new record high in the Indus, 41,500, just a little bit above the top. And of course, it left everybody thinking this is it. We're taking off again. But instead, the day after Labor Day, we've come down so far pretty hard. From a purely technical standpoint, I have to believe that this is merely corrective, but you never know. And my third scenario was the market makes a new high and just keeps going. But, and I don't discount that entirely because there's 50 good reasons why we should be starting a bear market now. We should have started it maybe a couple years ago. The market is way overdrawn. And, so because you can't really make a case for a bull market, you have to, as a contrarian and a technician, I have to think that it's very possible.
So are we in 2008, the worst depression recession since the 1930s?
Well, so far, I can't even say it looks that way. I can say that so far that's a possibility because, as I mentioned, from the day after Labor Day, we've embarked on a downtrend from this marginal new high. And you can just imagine that when stocks closed Friday ahead of the holiday weekend, everybody was pretty fired up. So at least so far, these first few days of post-Labor Day, which is really kind of a dividing point. Everybody comes back to work from the Hamptons, and they're serious about the markets. They've been kind of ignoring them in the summer, but they're not now. So what's happening is a reflection of let's say, full-bodied interest.
Well, if we are looking at shades of 2008, then that means real estate's going to take it right in the chin, maybe get poked in the eye and kneed in the groin.
Yeah, and that's happened to such a significant extent in the commercial sector that you have to be awed that the economy and the stock market, the phony bull market, even with all the stimulus, has survived. I mean, we've got a real estate collapse in the commercial sector that's overwhelming. I mean, it's really on track for being 1930s depression. And when you look at San Francisco and kind of play it forward, none of these high rises are ever going to get even half occupied again, never mind full. And that's playing out in big cities all over the country. Nobody's ever coming back to the office. And yeah, the buildings are getting marked down, but you can see even during the Depression when big buildings changed hands, a lot of the buyers they overpaid. Things were on their way to a bottom, but they got mistaken prematurely for bottoms simply because the collapse in prices was unprecedented.
Now, I think Vancouver is very unique in that the downtown core is also heavily populated. The West End, Yaletown is residential right up snug against those office buildings. And you can see if you can't convert that office building, take it down, turn it into a condo, people would live there because there's still, there's tens of thousands. But U.S. cities after 5 o'clock, there's nobody there. It's scary.
Yeah, it's very scary in San Francisco because there's even nobody there during the day. If you're on Market Street and in the south of Marketplace where a lot of new office buildings got built from the 1990s on. So it's pretty dead there too. And I'd say it's unsafe mainly in the Tenderloin district, which is no better or worse than it's always been. But of course, the shooting last week of the football player was really scary because it happened on Union Square at 2 p.m.
Yeah. So anyway, real estate then, that's not safe. Is there any area that you think people will escape to if real estate's collapsing, the stock market's collapsing?
There are just two answers. One is bullion, gold, and the other is treasuries. And I like to be against the whole world there and being very bullish on treasuries, but I am. I think we're at the beginning of a bull market, and even though I don't have the imagination to explain why the bond should rally, they're definitely facing some very powerful headwinds. That's what the charts say, and I think interest rates are going to. Again, I feel like I'm nearly alone out there, except for a few of my hardcore deflationist friends. But I think interest rates are going to come down, and don't infer from that everything's going to be rosy and we'll have 4% mortgages again. That even if that happens, it only means because property prices are falling precipitously, and that in itself means there can be no. We in the past we've had refi cycles where everybody got to extract the equity from their homes and even take a little cash out of the refinancing. There's no circumstance, I would say, possible that goes beyond imaginable where we're going to have that again. There's no way we're going to get a cash out refi cycle simply because the loan to equity value will be changing adversely. It's like you can't take cash out of a mortgage if your home has lost even a little bit of value, especially if refinancings are done with a 20% requirement. So so that sort of shades into the idea that whatever the Fed does right now in bringing rates down, they're just pushing on a string. And that's a very familiar term, but it happens to be true in spades this time because we've got such an incredibly pumped real estate market where everybody is they're sitting in houses where if they're mortgages at all, they're down in the 3.5% to 4.5% range. So there's no way we're going to get a refi cycle here, and there's no way that any reduction of interest rates is going to stimulate the economy.
We'll have more with Rick Ackerman right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, we ended that segment with you saying there's no way interest rate cuts will save the economy. And yet, we were saying before the interview, everybody's counting on the Fed saving everything with lower interest rates. Is that possible? Why this obsession?
I think that's a read you get from the newspapers. And, the only thing, the newspapers, I think, take the knee-jerk reflex that everybody's an idiot. But I think that people in their own lives, when they see, if they ask themselves the question, well, what will lower interest rates mean for me? It won't mean anything. And I think apart from what we read from the blithering idiots who invent the news at the New York Times and the Washington Post and Bloomberg and everywhere else, that there's the only thing that comes from lower interest rates is that the holders of financial assets get the benefit of inflation. But we are, I think, on a downslope of inflation now. We're certainly a ways from a full-bore debt deflation that even crushes all the winners from the last 20 years. But the only winners, if the Fed reduces rates, in theory, are asset holders. And assets are going to be falling in value now. So it's a deleveraging game. And again, there'll be no winners in a deflationary cycle. There'll only be people smart enough to protect what they've got.
So what is the best way to protect what you got?
Treasuries and gold.
Mm-hmm.
And I'm not looking at gold as something that's going to $50,000 an ounce. You know, my best forecast for right now is about $2,700 an ounce. I do think gold will hold its own relative to any other class of investable, but I think it really treasuries are the only safety. And even though they've been shunned and reviled pretty much everywhere, you watch and see what the world does when it's in a panic to put its money somewhere where it's not going to get swallowed whole by what's coming.
Taking a look at crude now, what's the scenario there? Because OPEC Plus seems pretty confused right now.
Forget about OPEC and even the clowns who rigged the markets. You know, they've basically been in a big swing holding pattern for years and years in crude. But I think crude's pretty much telling us we're in store. We've got a global depression coming. And of course it's hard to short the stuff since there's always the geopolitical threat hanging over our heads. But crude has been kind of arrogant and filled with hubris in that respect. It's basically saying, look, you're not going to have a squeeze on oil prices unless we actually see mushroom clouds billowing from somewhere in the Middle East, or who knows, even Ukraine. So the crude market is so cocksure in that way that no matter how horrible the headlines, the geopolitical headlines, crude's just copacetic. It's just mellow as can be, whistling past the graveyard, as it were.
So, taking a look at other things, NVIDIA, apparently they're under investigation, perhaps for being a monopoly when it comes to AI?
Yeah, right. I mean, you're going to hear all kinds of idiotic stories about NVIDIA, but the simple fact is that was a company that from the hardware standpoint was doing everything right. It really deserved a high valuation, but number one, not quite the valuation that it got, and number two, it didn't deserve to take the whole world higher on this AI hoax, and that's all AI is right now, is a hoax. It's just a lot of bull. I mean, I still continue to judge AI, especially since the promoters, the hucksters out there talking about it always refer to the large language models, these things that assimilate, absorb, process teraflops of data. In spite of that, you can't even get a straight sentence when you're dictating voice to text on a cell phone. So that's a language function, and as far as I can tell, AI has an IQ of 60 when it comes to handling spoken words. So it's pretty awful. And if you're reading something that sounds like, competent blather, it was probably written by AI something or other. But bottom line, AI has one purpose right now, and that is to eliminate jobs. And I can see that coming with Microsoft's whole network of technical support, places like that. So wherever you see some glowing statement about AI, just follow the money and the downstream of whatever is being discussed. It's always about eliminating jobs, and that's all it wants to do at this point. And it's probably all it's capable of doing.
Then that brings up the subject of a universal guaranteed income, because everybody's unemployed by AI.
Well, that's maybe the one great idea Bill Gates has ever had, other than screwing the people that he bought DOS from, and that is to tax robots. I think it's a viable solution since so many people will be replaced by robots.
So I know the EU is talking about a robot tax. If a company lays you off because a robot is now doing the job, they have to pay a tax to support you. or the other people laid off by the robots.
Yeah, but wait till you see how difficult it is to extend that law into areas that are, let's say, less black and white than manufacturing. If you go to Hollywood and talk about who's being displaced and exactly who should pay royalties for what, if you're training a large language, a language AI model. So we haven't even settled that technologically, let alone legally. So it's going to be, I'm all for taxing robots, even though it's going to deplete your capital investment and your manufacturing base. But in the end, it's too difficult a question to settle legally. The law will always be 5 steps behind whatever's happening in the technology.
Yeah. Usually by the time the politicians react, the disaster's over.
Or we're on to the new disaster.
Yes. So, Rick, what do we do with our investment portfolios? Are they worth anything? I guess pour it all into gold.
They are today, but you should definitely have at least 20% of your net worth in bullion, and maybe 60% in treasuries with not just the bills. You're getting pretty good rates in treasury bills, but also in the the note, 10-year note, even at 3.7, whatever it is, 3.7% is not a bad deal, since it's essentially riskless. So and you're still at just over 4% on the long end, 30-year. So could weigh that against the incredible risk right now that could be unfolding as we speak in a market collapse. So I'll take the 4%.
So, in other words, line your parachute with gold, if you can.
Yes, and just don't think of it as $5,000 an ounce or anything like that. And don't make the mistake of thinking that however gold performs, it's going to be a blessing for the long languishing exploration stocks. They've lagged for so long, and it's not exactly a positive indicator that these stocks can't even, they can just barely get in gear.
Rick, thank you so much for chatting with us.
And thank you, Jim, again. It's always a privilege to connect with your audience.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. If you have any questions for Rick or for any of our guests, you can send them to info@howstreet.com. We'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on X @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.